Hello, business owners and entrepreneurs. My name's Aaron March, and in this video, we're going to look at one of the most important, but yet most forgotten financial ratios, return on equity. Let's go. In its most simple terms, we're trying to work out how much money did you put in, and then how much money did you get back. It's simple to think about like a bank account. You can put your capital, which is this ball, into 3 different accounts: a 5% return, a 6%, or 7%. And so in this scenario, it's pretty obvious you want to get the 7%. Now, use the same theory to think about your business. What capital have you put into it versus what return are you getting out? The formula to calculate your return on equity is fairly simple. It's simply net income, which is income after tax, divided by your equity. There are 2 main challenges in calculating your return on equity. The first one being if you've got multiple entities within your group. What you need to do is consolidate the group so you can calculate the net income and equity for the group. The second main challenging is defining, well, what is equity? When business owners put money in and out of their businesses, it can be called a whole bunch of things. It can be called share capital, a loan account, UPE, or a Div 7A loan, or maybe even a subtrust. To make it simple, call all of these equities, net them off to see the total funds that the owners have put into the business. Then to complete the calculation, simply divide the net income by the equity. Now, everybody loves to analyze their business by looking at net profit to sales ratio and seeing where they land. That's great for comparing to competitors, but I'm going to show you why it's so important to check out the return on equity. Okay, here we have 2 businesses, business 1 and business 2. All of these numbers are in millions of dollars. Business 1 has got income of 20 million, expenses of 14, and it makes 4.2 million. It's got a net profit to sales ratio of 21%. Business 2 has got income of 30 million, expenses of 24, and makes the same profit, 4.2 million. But its net profits to sale ratio is only 14%. So instinctively, you say here that business 1 is a better business than business 2. This is where the return on equity comes in. Business 1 has generated the $4.2 million on $10 million of equity. That means it's got a return on equity of 42%. Whereas business 2 has generated the same profit, but it's done it with just $7.5 million of equity, giving it a return on equity of 56%. So what this means is if you were going to pick between either of these businesses, actually business 2 is the far superior business because it gives you a better return on your equity. To highlight the difference, if you owned business 2, you would have an additional $2.5 million to reinvest. You could reinvest further in business 2 and try to generate a further 56% return, or you could reinvest it in a new business, or you could put it into passive investments. Now let's introduce business 3. Business 3's got income of 20 million, expenses of 15, and a net profit after tax of $3.5 million. So it's got a net profit to sales ratio of 18%. And you can see, compared to business 1, again, instinctively you say that business 3 is a worse business. However, we then go back down and check the equity. We see that business 3 is only running off $5 million of equity. So then when we calculate the return on equity, which is again, net income after tax divided by equity, it's giving a 70% return. What you need to consider here is that business 1 has still made an extra $700,000 after tax compared to business 3. So you need to think about which of these is a better business. The question becomes, what return can business 3 get on their additional $5 million that they're holding? If business 3 could duplicate itself and invest the additional $5 million to create the total investment to $10 million and get the same results as the current business, then business 3 will become the superior business compared to business 1, because both have invested $10 million capital. Business 1 has generated $4.2 million in after-tax profits, whereas business 3 has generated $7 million in after-tax profits. The real question that you as the business owner or investor have to address is, can business 3 invest the additional $5 million and get a rate of return that's similar to the first 5? Return on equity is a financial ratio where being a business owner intersects with being an investor. Return on equity is one of Warren Buffett's favorite ratios. He looks for businesses that have got return on equity of a minimum of 20% for 10 years, with no worse than 15% in any year. If you've got a business that's got multiple product lines or divisions, you should run this return on equity analysis per product line or division to understand which divisions or products are giving you the best return on capital. Then you should focus allocating your capital to those divisions to create the greatest overall return for shareholders. So in wrapping up, return on equity is a great financial ratio because it can help you understand the return you're getting on your capital. Further, it can help compare your business to other businesses within your industry, but also external to your industry. It can also help you determine which of your products and services within your own business are creating the greatest return and therefore help you out with your capital allocation.